Thank you, Larry Pendleton, CPA from, well, we'll let you do your own intro because you got a few logos behind you. I'm not sure which one is your investment and which one is CPA related. So yeah, we're going to have CPA in the house today, do a little presentation on expenses versus depreciation, and then some Q&A stuff. I got some hard hitting questions here. I write small, so
is that your new notebook?
I guess it's my new notebook. I don't know.
It's amazing.
You wait though. Yeah, he's laughing now. He'd be like, "Really? You could have
Googled
Googled that."
10x notebook.
Greg, don't ask me anything you can Google, all right? And I won't. I promise. All right, it's all you, Larry. Please take it away.
Awesome. I appreciate it. So thank you, everyone. Thank you, Kim, for reaching out and setting this up. Larry Pendleton out of southeastern Virginia, Norfolk, Virginia Beach area. If anyone's familiar with the small area of Virginia where I'm at. So I've been investing for over up to around 6 years now. One of my investment companies is Rise Equity, which is this here. Others, I'm also a part of other different investment groups. I typically come in as the tax consultant, accounting person, underwriter from that standpoint there. And then most of that's kind of ran through my tax business, PC Financials, which is somewhere up here. And I've been running that business for over 8 years now. Been a CPA, tax consulting, tax preparation for over a decade from that standpoint. So, and really decided to tie the two worlds together with real estate and taxes roughly about 3 years ago now. When my mentor just kind of slapped me across the head and just said, just makes sense to kind of narrow my vision instead of being a journalist, just kind of being a specialist in taxes and real estate. Which is weird. I'm kind of going through my intro because it's in my slides as well. So I'm just go ahead and share my screen. So when Kim reached out to me, I said we discussed briefly like just various topics. We could have went through. I believe everyone's somewhat aware of the benefits of real estate, and especially when it comes to depreciation and being able to take these paper losses and not and take these huge gains that you get and be able to offset them with depreciation, as well as just it not being subject to as high as taxes as being self-employed with your business or anything from your W-2 from that standpoint. So what I thought would be very valuable to kind of talk about something that's more in the weeds, which is actually getting aligned with your contractors and how they can be of value from a tax perspective. A lot of times when I see people's tax returns and I look at a depreciation schedule, I see no matter the size of property, I see, for example, kitchen renovations, $10,000, and that's okay, but it could be so much better, because at the end of the day, like, what does that renovation consist of? Like, in actually kind of going through the details and breaking that stuff out, almost doing a bit of a cost segregation with your rehab and your repairs, so that you can actually expense more instead of taking that lump sum and having to depreciate that over 27 and a half years. But that's kind of where I want to kind of dig deeper into it from this presentation tonight, and hopefully I don't bore everybody to sleep. But like I say, if you have questions, like, please interrupt. I want to be as engaging as I can, as much as an accountant can be engaging from that standpoint, and we'll go from there. This is basically my intro of me. Really, how I started with accounting. It really started off with a crush on a high school teacher. That's not her per se. That's my wife now, but it took me a while to kind of explain that story to her. But she was the accounting teacher. It didn't work out with her for some reason, but I ended up kind of engaging more into accounting and kind of took the Robert Kiyosaki poor dad route of went to school, get good grades, get a good job, and I did all that, and I kind of lost a sense of like my value and purpose. Um, and and then that's when I kind of stepped away for a bit, and it's kind of like, hey, people are struggling with their taxes, and a lot of times just someone to actually kind of be more personable and kind of explain what's going on. So to be able to kind of take that love and their appreciation of helping people and to their taxes, and I feel like that there's a lot of value that I can add to a lot of people from that standpoint there. So yeah, but everything else I kind of explained. I mean, love real estate for a number of reasons, mainly for the wealth generation aspect of it, as well as for a lot of people to reduce their taxes from that standpoint. Um, just kind of disclaimer: this is all this information just in general purposes, no legal, any individual tax advice. I always recommend discussing with your tax professional or with your personal CPA, enrolled agent, anyone that can go into detail about your specific situation, because it's always a case by case. The greatest answer any accountant and a lawyer will give you is it depends, and there's a reason for that. The law itself has become very convoluted, and there's no way we can kind of answer like every single situation within an hour time frame. We could try though. So things I want to kind of go through. One, just the why expensing is better than depreciating. I know depreciation is great, but we'll go into more details of how that relates back to the repair costs. Um, how to like which repairs do qualify. We'll go into a bit of a high level regarding that and how your contractor can help you with that. 1099s, kind of a big deal. I know it's just one thing people don't really think about until after the fact, but like I said, the more you can kind of think about it up front now, the easier it is to kind of shape, okay, which contract you're going to work with and so forth from there, and then we'll kind of go into a bit of a summary of all the information that we went through now with. Um, so we're all good to go. We can jump into it now. So um, various reasons why expensing versus depreciation is in question, because people like hear depreciation, they hear about the benefits, and depreciation is great most of the time. Um, and I'm just from a high level perspective. I mean, for people that don't know what depreciation is, it's basically you can't expense the cost of the building. Even though most investors would probably argue against that, because it's an income producing asset, a little accounting geek term there, it can't be expense. So what the government allows, especially that you're providing rental housing, is that okay, if you're providing a service for the public, we'll allow you to recoup the cost of the building over 27 and a half years for residential buildings, 39 years um, for commercial office buildings from that standpoint there. So depreciation is great for that aspect of it, because you're taking something that can't be expensed and now you're able to somewhat recognize that over a period of time. The difference with the expensing part is expensing is great. Expensing is great all the time. Like we're all trying to like get as much write-offs as we can. We go through this every year with our tax pro, like what can I write off this year and so forth. So we know that like being able to expense this year is better, and you don't have to worry about depreciation recapture on the back end if you ever decide to sell your property. And what is that? Basically, if you bought a building for $1 million, 5 years later you sell it for two, but you recognize $500,000 of depreciation. You don't have $1 million gain. You really have a 1.5 million dollar gain, because the depreciation reduces your cost basis, and now you're having to pay. The government say, okay, you're selling that building that we give you a depreciation benefit for. We want that back since you're now selling the building, because we can go and give it to the next person, and now you have to pay for that additional gain. So the expensing aspect of it, you don't have to worry about that because that happened in year 2021, and you don't have to ever worry about that coming up again. And you got documented evidence in place to kind of recognize all of that. So I kind of jumped ahead a little bit, but the also aspect of expensing is that time value of money. Especially, Biden's trying to get a lot of stuff passed right now. We don't know what's going to happen with 1031. We don't know what's going to happen with the step up basis. We don't know, like, that's just kind of like the big highlight stuff that they talk about in the news, but there's always some other stuff that kind of comes up down the road with these new tax laws. Same thing happened with Trump, same thing happened with Obama. Like, no matter which president is placed, I really don't really care from a policy perspective. If they change the tax code, whatever is initially brought up front, there's other stuff in the weeds that you always have to kind of be mindful of. So the more that we can recognize up front and benefit from being able to take those deductions this in the current year that we're in, that's better, and be able to make, I guess, reduce our tax liability from that standpoint. That's better than having to break that out into multiple years. And I talked about the capital gains aspect of and be able to reduce that because we're not so wrapped up into depreciating all our repair costs and be able to break those out into items that are expense. Quite a bit there um, that I went through. Questions before we move on?
Yeah, maybe just from a cost segregation point of view. I mean, we do the accelerated depreciation through cost seg, and I know we've had at least one conversation and this was a heavy rehab project where there was some opportunity to capture the value not only of the things that you were or depreciate the value of things that you were adding to the property as a rehab, but also things that were going in the dumpster, and that it ended up getting so granular that we can keep up with it, trying to track everything that was being disposed of and getting some kind of tax benefit for that, while at the same time trying to keep track of everything that we were adding. So is kind of what you can only do one or the other. So we rehabbed unit 10 and it costs $10,000. It's an expense. The other option is to depreciate at least portions of that expense.
Yeah, so to kind of address your first comment regarding the cost segregation, let's just take that same $1 million building because those were the bit of the worlds get kind of crossed, but they relate at times, but not all the time. So cost segregation is taking the cost of the building minus the land, and then it's breaking because that building itself isn't just all that is not 27 and a half year property. Part of that is personal property. You have 5, 7, 15-year property. So the cost segregation is kind of breaking that up into its separate buckets from there. So where the aspect of, okay, what you throw away can now potentially be expense is because, okay, let's just hypothetically say you ended up replacing the windows, um, and from that standpoint, which is not always 27-year property, is really more seven-year property from that standpoint. There, okay, you replacing those windows, the value that was left over from those windows can now be expense because now you're bringing in a new set of windows that's going to be depreciated going forward from that standpoint there. So let's just hypothetically say in year one that you do have those windows kind of broken out, you end up doing bonus depreciation on those windows. You may not get those replaced until year two. Okay, you may even hold off from a cost set perspective because you end up that the whole depreciation recapture aspect of it, but you're expensing that, but then you're replacing them with new windows. From that aspect there, if that makes sense.
Yeah, it does. And I don't know if things got less complicated with this bonus depreciation in year one, where it seems like the cost segregations got much more streamlined and easier. It's like you're just taking everything up front, and
It it's more straightforward because, like, yeah, if it's 5, 7, 15, yeah, we're going to expense all of that in year one, and or not expense, but we're going to fully depreciate all of that in year one. The complicated part is that whoever who's doing this for you and recognize it is really is the choice of, do you want to recognize all of that in year one? Because if you end up selling that building in year two or year three, you really didn't maximize the full value of it, and you still got to deal with depreciation recapture. So at least if you end up holding that build, holding those items or that building itself for 5+ years, which is typically the sweet spot, because you get the full value of the depreciation. The most of the value is gone, and you have less depreciation recapture to deal with from that standpoint there. But you still want those items broken out separately, because even though you may not sell, even though you may or may not sell, you still have the option of, okay, you got, so even for example, let's go with the roof. The roof is still a 27.5-year project because it's part of the structure of the building. You can't have a building without a roof, from that standpoint. You can't have a building without windows, ironically enough, but you can't have one without a roof. So if you end up having to not breaking, if you didn't break out that cost of the roof, even though you can't bones depreciate, do a bones depreciation on it because you can't recognize that, like, you still, and you replace that roof, you end up depreciating two roofs because you don't have that old value broken out. So if you had the old value broken out, now you can route the value of that old roof, and then that's going to be replaced by the new roof, even though you can't fully depreciate it in year one. But then it kind of tied back to the presentation. If you're just doing like random repairs and minor just patchwork on the roof, depending how you have that invoiced and broken out and itemized on your invoice, you'd be able to expense those repair costs of the roof because you didn't do a full replacement. You just ended up doing repair costs. I guess I'm not repeating myself.
Mm-hmm. And that's why I don't do my own taxes. 'Cause, yeah, there's a lot going on there, man.
And once you look at it long enough, you become psychotic enough to enjoy it. So
yeah, okay. So yeah, I hopefully I did derail. Yeah.
No, because I'm about to derail more because I'm
All
so
right.
hung up on it. Okay, so probably from previous conversations with Greg, Larry, you figured out we had this big hairy project. So let's say we are selling this building after 2.5 years, and we've done this huge cost seg study.
Completely hypothetical, right?
Completely hypothetical, saving hundreds of thousands of dollars in depreciation because of bonus depreciation, cost seg, the whole 9 yards. Well, let's say that building's going to close like next week, maybe, and you're going to get proceeds and pay off all your debt, put a little bit of money in your pocket. When we file 2021 taxes, is the big old hairy IRS going to say, hey, man, remember all these proceeds you got last year? Is this when we may have to, pony up for recapture? That's my number one. That's my concern. And then number two, I'm trying to understand the difference in, is the advantage of doing an expense, even in this project, more simply because of the recapture at the end? Is that the biggest reason to expense instead of cost seg? So that's sort of asked two questions there.
You can cost seg without the bonus depreciation. So I think because that's always the aspect of the people instantly tie the cost seg to bonus. Even though there is a direct correlation, you do not have to do a bonus depreciation with your cost seg. You just have a very large depreciation schedule kind of showing all these different items, and all will be depreciating at their own proper rate. Because technically, if you don't do that and have everything broken out, you really are illegally reporting your depreciation. The government's not going to say anything because that's less they can tax you on. So they'll gladly not tell you to get your 5, 7 year, 15-year properties kind of broken out appropriately from that standpoint. So part of yes, would they still be knocking on the door even if you didn't, because you still have some depreciation that you benefited from in the past two and a half years? Yes, but then that's just part of the picture itself, where it's like, okay, you bought this property, you claim some depreciation, bones are not from it, you have these gains that you occurred from it, Now, how do we offset that? Now, do we do a 1031? Do we start opportunity fund and do you put the money in there and kind of look for opportunity there, or do you just buy another property, cost seg that, and then that's going to generate a whole bunch of losses that's going to offset the gains from that property you just sold? Eventually,
Yeah.
eventually creating your own 1031 without going through a whole custodian and all that stuff there.
That's what a
Okay.
lot of people do that we know, that they go buy a building, cost seg, and within 5 years, they go buy another one the next year or next year after that. And when that bonus depreciation runs out, though, typically in like if year 5, maybe if I'm not mistaken, they may or may not.
Yeah, most of it is ran out in year 5 because there's really not much 7 and 15-year property. Most of it's going to be 5-year property, and that's going to take up most of it. Like if for any building, it's roughly from my assessment, 10 to 30% of it is property that's eligible for bonus depreciation, and then at least 60% of that 10 to 30% is 5-year property. It ends up being a majority of what's being broken out.
So am I being paranoid in the fact that when we pay taxes next year that, they could potentially ask for some of our gains back based on our bonus depreciation? Am I understanding it correctly?
If you just stop, yes. If you just kind of stop, we just sold this property and you were just done with real estate, then they're going to become, that's going to be reported as that potential gain there. That's why the interesting thing about real estate is that's why people 1031 until they die.
Yeah.
Because you're constantly, you have to keep, eventually the roosters come home, or the hens, whatever the,
Yeah.
my wife always calls me
Yeah.
messy sayings, but it's like everything eventually comes back. Eventually everything runs out. Everything phases out. If you just kind of stick to
musical
just one.
chairs. It's musical chairs.
There you go. Thanks, David.
Yeah.
I was still there, give you no credit. But yeah, it's that same aspect. You literally have to keep going. Like you literally have to keep buying, especially if you're going to sell anything. Because at that point you're just a flipper, and now you're subject to self-employment tax there. So you almost have to keep accumulating more rental properties in order to offset the benefits that are running out of the old ones or the ones that you're about to sell, especially in a time like this where the market's high. But then, do you have something you can buy in a hot market across the country to help offset that?
Does the IRS look at your amount of your gain to know, oh man, they made out big on this, we need to go back and recapture this much from them? Or if that gain was really small, do they care? I know that's a subjective question.
I mean, they're going to care either way. It's just how is it all being reported, because there's the gross proceeds, and then then we got, even though there's the depreciation recapture aspect of it, there's still the expense of selling the thing. So you still have to get a broker involved and all those fees and whatnot. So there's additional expenses that kind of get caught along the way. And depending on, he said it's 2 years, because it's almost an aspect of, okay, if you was always planning on selling the property, then was it worth the kind of benefit that in the previous years, or kind of treated similar to more of a flip where you just kind of hold on to these expenses until you know you're going to sell in a year or two from that standpoint there. But I know a lot of people are just kind of hopping on the market right now because it's almost ridiculous not to sell, because people are buying at ridiculous prices right now.
Yeah, thanks for trying to help me. I need more.
Quickly, David, you had unmuted yourself. Did you have a question that you wanted to?
I had made a comment earlier, or I was going to make a comment earlier, that I had the same concerns about, a deal where I'm involved in now. We did a cost seg study, and we may not own this property more than 24 months. But it seemed, what I was going to say is, I think from a bonus depreciation standpoint, it's the depreciation is what it is. When you do a cost seg study, it may be up to the individual investor how much depreciation you take in that first year. Would that be correct? Like,
Yes.
if you know that you're not going to hold it more than 24 months, for example, you wouldn't necessarily have to take all of the bonus depreciation. Is that correct? Like, you
Right.
could say, hey, look, I know I don't want to get myself in trouble. Like, kind of what Darren's saying, like, hey, we're about to sell this, or I know we're going to do okay on this in, say, 24 months. I don't want to have to pay more in taxes then. It's kind of, I don't know. I have the same concerns about the cost seg, but if I'm reading you right, cost segregation is not a bad thing. The depreciation is not a bad thing. If you fully depreciate, or if you do the bonus depreciation in that first year, just know that if you sell early, you're probably, they're going to want some of that back. You're just not going to have the same gains, personal
Right.
gains.
Like none of it is bad. Like I say, I don't want to get the impression. I don't want to give the impression either it's bad. Only thing that's bad is misinformation.
Just go in with eyes wide open. Like, no,
Right. Like
it's gonna come back.
you can do the cost seg analysis and not break out anything. You can keep everything lumped into one number, which is what most people do anyway, and the government doesn't really question it at all because it's a safe conservative approach. Is more aggressive tax strategy to break out stuff separately from that standpoint there. So it's not bad per se to get the cost seg analysis. It's not bad to do the bones appreciation. It's not bad to not do the bones appreciation, just have everything broken out. And it's not bad to get the cost segregation, see what the numbers look like, and keep everything in one. You just know what your plan is going forward. So like if you know you're going to sell it, uh, like in basically more than a year or less than 36 months. So from that standpoint there, but you know you're going to acquire something else down the road. Okay, we just need to know we need to have something with a large enough basis that can create a big enough loss that can offset the gain. Like I say it ends up becoming. Let's see what the full picture is. Let's know what your plan is, what your goal is for this property, which is always going to be pivoting. I mean, everyone can have the greatest plan in the world, but something changes, and then like, okay, we can sell this thing for 5 times as much as we bought it for. You may not get that in your 5-10 year plan, especially if you're syndicating from that standpoint. So you're almost like, hey, do we pay out the investors now and have a full turn on it quicker than what you all expected? That's just kind of what the change in markets typically can do.
Yeah, I mean, can you model that kind of stuff? I guess it would be specific to the potential, what the hell is it called? The recapture.
Yeah, basically
I mean, if you're entertaining a sale and you're like, okay, I can figure out sale proceeds and stuff, it's beyond my scope to figure out what my potential recapture would be. I mean, is that something that a CPA can help you with, is to model out the full scenario?
Yeah, because the simplest way to do it is to kind of look at the previous depreciation schedule, see how much depreciation um, um, was captured, I guess for lack of a better term, and then that becomes what's going to reduce the basis of the original cost basis of the property itself. And then okay, depending on how long in the year you held it, especially if you held it for whatever 9+ months, or for any point of the year that you sold it, you're just going to add that to your total depreciation, and then the recapture piece is simply enough as just reducing your basis by that amount there. So kind of back to my $1 million building example, if you end up claiming $500,000 of depreciation over the years and you sell it for 2, your gain is now 1.5 million, not 1 million that you originally bought it for.
Okay, gotcha. All right.
Then we'll get into like personal, like where everyone's individual like tax bracket is and effective tax rates and all that stuff.
Yeah, because I mean, that's the whole other thing is it
Yep.
trickles down to every individual person's tax liability or situation. So, okay. All
But
right.
typically, the best way to look is like, okay, what's the highest tax bracket, or not, what's the highest tax rate, to kind of base it off of, and I
Mhm.
typically use like 40%, and that includes federal and state to just kind of give his potentially the worst case scenario. Um, now if Biden turns around and able to increase the long-term capital gains rate, okay, now I have to adjust what my particular ratio was from that standpoint there. I said it's just all just kind of adjusting to what the politics are trying to do, as well as what the market is at the moment now as well.
Right. Yeah, that's a good point. Yeah. Anticipating what future laws might look like is everybody's crystal ball, but who knows? All right. Well, we got through the first slide.
Well, we still have a question in the
Oh, okay.
chat. It's a little bit different than what you guys were talking about. So,
All right. Now let's switch it up.
so the question is from Steven, and it says, for short-term hold, fix, and flip, any recommended accounting practices? Also, if one only does short-term buy, fix, and sell, is there any way to avoid being classified as a dealer? Before you answer, Larry, we have an answer from Darren. So Darren says, from his experience in Tennessee, only does them in his personal name, not an LLC, and charges a 10% self-employment tax and the franchise excise tax on my LLC.
I used to do them in my LLC, and now I do them in my personal name
Personal
because
name,
now
right.
I avoid a 10% self-employment tax as well as a franchise and excise tax
Oh, I read that wrong.
on
I'm
my
sorry.
LLC. Yeah,
Sorry,
that's okay.
I read that wrong.
That's just in the state of Tennessee. So
How many are you flipping in a year?
half a dozen. Sometimes.
Ask Steven that.
Yeah, well, Steven's chat only, so I'm waiting
okay.
for his answer.
Oh, sorry. That was for Stephen, probably. Yeah.
Or both.
Yeah, typically it's almost a volume question. So you say if you do a half a dozen, that's 'cause typically to avoid that, from my experience, to avoid that dealer classification is you almost have to do like one or two a year, from that standpoint. But I haven't dealt with many flippers in Tennessee, so that's interesting that you can get a half a dozen and not get that status. But the aspect of not having it in the LLC, definitely helps from that standpoint there.
Yeah,
What's
but go ask your lawyer that same question, Darren, and see what kind of answer you get.
Oh, I know what they'll say. Yeah.
Yeah.
What's a dealer status? Because I'm actually not familiar with that.
So basically, the dealer status is what is subjecting you to that self-employment tax, from that standpoint there. So it's saying, okay, you're a dealer, okay, you're going to get taxed on that. You're actually running a business per se, and you're going to be subject to these self-employment taxes there, for kind of a quick way to explain it from that standpoint there. So a lot of times people are trying to avoid that additional, self-employment tax by just trying to find different ways. People just kind of slow play their flips at that point, maybe do less, from that standpoint, or kind of do the long-term flips where it's only like they may take a year or more, a little more than a year to actually, they're not in a rush to kind of get the property done, from that standpoint there. But it depends on their business model, and then a lot of times people just kind of avoid the whole thing, do an LLC, tax as an S corp, pay themselves a salary, and go from there, as well.
So if the state wanted to nail me or IRS, they could, but I forgot a really cool CPA. They hopefully help me out anyway, but I guess they're going to find you out in the end. Yeah, and S corp, not familiar enough with. Greg and Kim use that, and I've heard that could be to my advantage. But anyway, I don't want to get off too far off track.
That S corp election, like I said, that's really is you saying that you are a employee of your business, and at that point you're making enough money from your business to pay yourself a salary, so that your active income itself, that total number isn't your total gross isn't net, isn't such as self-employment tax, just your salary portion. And then anything else that you distribute to yourself is not subject to that self-employment tax.
What's the minimum you have to pay yourself?
It's a reasonable salary.
Oh, so $20 a month sounds awesome to me. Okay, I see where that's going. Sorry.
We're recording this, you know, Darren.
I know, this is like, Darren has been found out.
Larry already threw up the
Right.
disclaimer, so I'm going with the disclaimer. All right, I'll jump off.
These are all hypothetical situations.
I have to say reasonable. If it's reasonable for the pay yourself $20 a month, like who am I to say?
Yeah, you might want to have it hit the minimum wage, like the federal minimum wage, you know.
We'll start saying Warren instead of Darren, and that'll help.
Oh, okay.
Or,
All right, I think now we're ready for slide 2.
I think it was a short-term hold, and kind of the same thing, Stephen, with your short-term hold question, and that becomes a bit more, a little more detail in figuring out like how long is your average tenant staying there. These like more Airbnbs that people are kind of staying for 7 days or less. Then you don't have a passive. You still can recognize depreciation from that standpoint, but you don't have a passive business per se as just regular rental real estate. Now, if you're doing kind of the extended stay short-term rentals, where people are kind of there for a week or a month, then like I said, that would still be considered passive from that standpoint there. But the same depreciation kind of still plays a factor there. Unlike flips, where you don't get the benefit of depreciation there, but you get to recognize all your expenses at the end when you sell the property. So hopefully I was able to answer your question, Stephen. Thank you, though. Thank you.
He says yes, thanks, good answers.
Okay,
And there we go.
So I almost forgot what we were talking about. So qualified repair costs. So that whole aspect of, okay, we want to expense these repair costs as much as we can, because the IRS has a bunch of different regulations related to tangible property, and there's different tests and safe harbors that you can qualify for. And this kind of just some of the stuff that kind of plays a factor is the dollar amount, how everything is invoiced, because that ends up being the supporting documentation, and then as well as type of repairs are being done. Like I said, if we're doing massive like gut jobs, or just replacing something completely, or just kind of repair and maintenance from that standpoint there. So what your contractor can do, and typically these require conversations up front. You're almost having to lay down these expectations, and depending, I know it becomes a bit of a almost like pulling teeth per se, depending on the size of the project, depending on the contractor. Like, they're not paper pushers, and that's not what they're good at, and they may not have the business built up to itemize their invoices to show, okay, here's all the materials that they end up buying from that standpoint. So you're just not wrapping painting with roof repair. Like, those are two different things, where like you can actually expense the painting, because that's why is that being capitalized, especially if we have that lumped into the number with your roof repair costs and everything else from that standpoint there. Also, could they provide like multiple invoices between the labor and the actual material from that standpoint there? Because, and one of the safe harbors that we'll talk about right now is the de minimis safe harbor. Basically anything, and there's other ones as well, but the simplest and the quickest one to kind of go through is, if anything less than $2,500 repairs just can be expensed. Like, if that's what is shown on the invoice, you can expense that right away. Now, if you get into, okay, something that costs $3,000, okay, can that be broken out between materials and labor into different invoices, so that now you can expense both? Because if those numbers are together on the same invoice, even though they're broken out separate in the line, that's your supporting documentation. The IRS, and if you ever get audited, they'll see, okay, you did HVAC repair, uh, 2,000 for material in one line, 3,000 for labor, or 1,000 for labor on the other line. They're just going to see that as all should be lumped into one. But having the two separate documents kind of help provide that support, and maybe anal and tedious and maybe unreasonable, but for you, like it creates this huge benefit on the front end, because once again, we're now expensing and instead of depreciating and not have to worry about that recapture on the back end from that standpoint there, as well as being able to recognize more expense wise and this year as well. And then timing of projects of your repairs, especially if you're doing projects that's going to be close to the year. Okay, do you want to hold off stuff until the next year? Do you want to front those costs in 2021, for example, so that, or prepay for some of that stuff in 2021 so that you can have more losses because you got something else planned for in 2022? That's what kind of helps when you kind of lump in your contractor with your tax professional. And for example, like I'm working on I'm part of an investment team. We got a 20 unit in Cummings, Georgia. It's actually 5 quads per se. And okay, we'll get through 3 of them in 2021, and then we'll deal with the other 2 in 2022. Really, and that part was kind of like just because of how people are moving in and out of the units. But we had that conversation with them before we closed. It was like, okay, our contractor guy or our rehab specialist said, you gotta go talk to Larry. He wants these things done. And of course, he never heard of it because, like, why would anyone ever speak of this stuff in detail? Because it's a lot more paperwork that I have to go through, but I know the benefit for not just me in the company, but for our investors as well, without even talking about doing a cost seg at that point. So we're able to kind of drive up some losses or drive up expenses to kind of build those losses up without even worrying about that aspect of it now. So that's just something that kind of keep in mind from that standpoint of, and then the other safe harbors that kind of allow for more expenses if you happen to surpass that 2,500, depending on the size of the property and whatnot as well. But the minimum safe harbor is kind of the go-to for a lot of CPAs, especially those that specialize in real estate, and then working with your contractors on getting stuff itemized from that standpoint. So, questions on this slide that we can take another 20 minutes on?
No, that one's a little more straightforward.
Also, so I want to kind of give a quick example of what I'm talking about. So I went through this scope of work with a contractor of a property that I got up here in the city called Newport News, Virginia. It's a 16 unit, and he basically, I wanted to see the scope of work, and I wanted to kind of go through everything. Like what was labor, what was material, like, okay, the siding, okay, there wasn't much, it was a lot of siding we had to get purchased and a lot of labor for that aspect of it. So, okay, we got to depreciate that. But the windows, for example, here, now, if I'm just looking at the numbers, the dollar amount, then I may have to, it may be appear that I have to depreciate that. But what I wanted him to add was this number here. I wanted him to add 50 windows because that's what we ended up having to acquire. So that now it's not windows this amount, it's 50 windows, so that like 50 divided by 10,000 is now less than 2,500. So now we're able to expense all the windows that we purchased. So we're able to expense this basically nearly $19,000 in year one because we added the details of what these windows were from that standpoint. Same thing with the HVAC units. Even though people typically see HVAC as a typical CapEx item, which it is, but it's 5 HVAC units compared to 16 in total. So now we're talking about a small percentage. Typically, the sweet spot is no more than 20, no more than 30% of the items are now being are now being replaced or repaired. So now we're saying, okay, we have these 5 HVAC units that we're going to be expensing from that standpoint there. Same thing with the furnaces here, and then and so this was something that I kind of left this one because, like I said, we was kind of going back and forth. I think he just got tired, or his person got tired of breaking everything out, and just kind of lumped everything here. And it's like, no, I want every single thing lined up with what's going on with this unit because I want to be able to expense it. And we ended up getting it done. Like I said, it was just this kind of evidence of like, okay, here's, and then our invoices are kind of shown from that standpoint there of we have an invoice just for all the different labor items and our invoice for all the materials as is lined up in the scope of work, so I can tie back from a accounting perspective on the back end.
Okay. Well, I mean, my assumption is then, or am I thinking about this right? If a CPA sees something drop into CapEx, then you're thinking in terms of depreciation at that point.
Well,
Just in terms of buckets, you know, if something has been called CapEx on a P&L, you're like, that's probably a depreciable item.
No, my first thought is, what is it? Like
Okay.
if it's in the bucket, like unless it's just kind of clear as day that you had whatever a huge apartment building with one HVAC unit and you replace that one HVAC unit for that whole building, then it's like, okay, we're like, yeah, that's CapEx. But even with that, I'll still have to ask how many HVAC units is in that number. Like I say,
Okay.
it's never just unless it just replace the roof. Okay, all day, every day, like you say you replace the whole roof. Okay, we gotta depreciate that. If you tell me that you repaired the roof, okay, what was repaired? Like how much of that was repaired? It's almost not just it's a responsibility of your tax professional, your tax advisor, to not only guide you on what to provide, but to also ask questions on what you're providing as well, because not everything is black and white in that aspect from that standpoint. And I said I have to know more about what's going on with your capex items, so that do we have opportunities to expense stuff and get stuff off the depreciation schedule that shouldn't be up there. The only thing that really should be up there, are actual true items that that truly have to be capitalized from that standpoint. And I'm trying to avoid that as much as possible. If I can expense the whole purchase of the building, I will. But as I say, I can't do that. But I'm gonna use this tax code as much as I can to extract as much as we can out of depreciation.
So okay. So let's just say like, let's say you do that. And so like, I get it. You're minimizing your taxable income there, which is great. What do you do when you go to sell and you want to show that you have a pretty beefy NOI?
That's a good question. I'm actually working with a couple of lenders on this logic of mine, and a lot of them are kind of seeing where I'm going with, and indulge me for a moment here since you brought it up. So it's your fault, Marshall. So your lender should not be recognizing depreciation as part of your, like no one should be recognizing depreciation as part of your NOI. That is a below NOI item that's still expense, which is what really drives people NOI from being in the positive to being in the red for tax purposes. This particular strategy with using this tax code is the exact same logic of depreciation. I'm using a tax code to take capex items out of that, which was already preset to be capex, and to be expensing that from that, to be expensed for that year, and should be treated below NOI because these items are not operational expenses. These are CapEx items that because of a tax law, we're able to expense similar to depreciation from that standpoint. So, and oops, so I actually have walked through this with this particular example with one of my lenders because we're showing um, additional $90,000 of capex expenses that we end up breaking out of that from that standpoint there. Um, and and for most of them that I've talked to, I get the same answer. This is a one-time thing, which is true. Like which is really true. Your capex items are truly just a 1 year thing, especially when you first acquire the property. From that standpoint, there was like, okay, you did all this work, you expense all this, you can't ring this bell again because you don't have that much capex on a year by year basis or year by year perspective there. So yeah, so this ends up being more of a below NOI item, so that you still are showing whatever your beefy NOI from that standpoint there, if that makes sense.
Yep, that makes sense.
Yeah, I've had painstakingly conversations of walking through this multiple times with at least four lenders, just from like, because I think I don't think I know it makes sense. I just when someone told me it was a one-time thing, it's like, okay, that's the caveat. It's only it's a one-time shot. Um, and depending on when you sell the property, and most likely it's years down the road where it's like, okay, it doesn't even matter anymore from that standpoint.
Right. Yeah. Cause that's what I was thinking.
Yeah,
Your kind of your P&L strategy changes a little bit with where you are in the hold. As you get closer to wanting to sell, you want to obviously, put your NOI in the most favorable light as possible.
especially if you a lot of these, even if you're not selling, most of the time you're in a bridge. So now you're looking to just refinance at that
Mhm.
point. So that's where you're kind of pushing for that argument there of these items, because one, you're trying to benefit your investors by having huge losses um, for them to recognize. You're trying to refinance, so you're trying to show a beefy NOI when you're trying to refinance or sell, and then you're also trying to mitigate the future capital gains hit by not having so much in depreciation for them. So it's addressing three different birds at one time. Can you kill three birds with one stone? And we will try to do that.
Mhm. Okay. There's a lot of nuance to this stuff. I think, that's what my personal kind of misunderstanding. There's a lot to this stuff.
Yeah, I mean that's when the documentation becomes huge,
Yeah.
because you can start to lose a lot of this. And as I tell people, and one thing I didn't mention in my intro is that I like in my days in public accounting, I was an auditor and in taxes, so I played both sides. So I never was an IRS auditor, but all auditors think the same. Is the documentation there is to reasonably support what's being what's being shown to me here, and no one can do it 100%. Like IRS doesn't have the resources to tie everything to the penny, but they are looking for certain, like, okay, they got certain thresholds, or big numbers just draws people's eyes anyway. So that's always what's going to draw attention to it. So if you can kind of take advantage of that, and get the proper documentation in place, so that when the door comes knock, because I don't prepare taxes to not be audited. I prepare them to be audited because we're taking aggressive approaches here, and I gotta protect your blind side if I'm gonna take you down this yellow brick road.
That's a great quote.
I typically stumble across it, but I'm glad I made it to the finish line with it. Hit the landing. Cool. Any other questions? I thought having an example can help.
No, I mean, my contractor's going to hate me now. That's all I know.
I am causing some issues nowadays with that, and like I say, is any day, especially as we kind of get further deeper into this and we start talking about 1099s and something you haven't really brought up front, then this just kind of adds fuel to the fire from that standpoint. Cool. Um, Speaking of 1099s, kind of a big thing. So if you haven't been doing it, just keep in mind that is is definitely a risk of not doing it. The penalties do kind of range a bit, um, but at the same time, you can also kind of start off with just giving your contractor a W-9 from that standpoint. The W-9 like that just kind of gets their, okay, are they a sole proprietor? Are they LLC? Are they S corp, C corp, whatever? Um, and then you get their EIN number, social security number. So at least you have that in place up front, and it creates less chasing down on the back end, which I have plenty of clients doing it now. Because a lot of times people don't know, like if the person is a C corp or S corp, like payment to them aren't like you don't have to issue a 1099 for that because corporations have more stricter guidelines in regard to having to pay salaries and whatnot. So they are more inclined to show all their income to support the salaries that they're paying. Now, not so much from an LLC as a sole proprietor because they don't have to pay themselves a salary from that standpoint there. So, just kind of stuff to keep in mind. If you haven't been issuing out W-9s or to get the information up front or getting the 1099s on the back end, and it's very important to discuss this with your tax pro before the end of the year because they are due January 31st, and that's in the midst of everyone's trying to close their previous year books and get ready for tax season, and but those 1099s have to be issued to the IRS and submitted to your contractor by the 31st of that following year. So just kind of keep in mind from that standpoint there. Like I said, there are penalties if you was filing and it wasn't recognized. There's penalties for incorrect information, so that's why the W-9 becomes even more important, so that you have a signed document from your contractor saying, "Here's my information," and they're validating that by signing it from that standpoint there. And depending on, like I said, the penalties, like I said, could definitely range between $30 to $500 per form, and that does not include just interest and penalties that can be built up. Uh, or interest can be built up for the number of years from that standpoint there. So, and you want to be able to comfortably recognize those deductions on your tax return. So, a pain in your ass for your contractor, yes, but at the end of the day, you are the customer. You have to protect your business, and them not wanting to conform and work with you from this aspect of it. You really may have to consider, okay, how you want to operate your business, because it may not be the cheapest person at that point now, if who's been trying to run stuff under the table. But at the same time, like I said, this is a business that you're running above board, and you're trying to recognize as much deductions as you can without the concerns of. I have clients who just don't do it, and they just like screw it, don't include it up there. And it's like, okay, you're talking tens of thousands of dollars that could have been very useful to have that deduction on your books from that standpoint. So, questions before we go into 1099s and and all that good stuff.
So does the W-9 have to be collected for each tax year? So if you're using a contractor year over year, do you have to collect a new W-9 for each tax year?
Only if they're switching entity names or entity structure or EIN. So you may just want to confirm if you're using somebody from year, are they still
Okay.
ABC Incorporated and they got the same EIN number. You just want to kind of confirm, but you don't have to recollect it from the same person every year.
Okay. But it might be worth it just to check in and say, hey, did you have any changes? Or here's the one you gave me. Is it still accurate?
Yes.
Okay.
And what they do with it and they report it, that's on them.
Yeah, right. I mean, yeah, you throw in your half and what they do with it is
Yeah, you did your
their
part,
problem.
and the government asks, "Hey, what happened to the Darren? Why he ain't report his 1099?" Like, I don't know. I haven't talked to that guy in 3 years.
Loser.
So awesome. So now, I mean, we're like I said, I ain't want to have a too long of a presentation, but I mean, I mean, for me, it's like you got the accountability aspect of things, um, for to hold your contractors too from this standpoint, and as well as to yourself, because like you're protecting your business. You're now incentivizing. You can incentivize your contractors to do stuff like this more because that's repeat business, that's referrals, and as I'm talking to more contractors, like you can make yourself more investor friendly by having this stuff up front, and to you don't have to they don't have to go into much detail of it. It's just here's the benefit from other investors that you can provide from that standpoint. And like I said, you can actually educate your contractors um, from that standpoint there of how they protect their business with the 1099, make sure they're reporting everything from that standpoint. They can actually be more of value to their own portfolio because a lot of these contractors actually are investors as well. So now that they're aware of this, now they can benefit off this as well and kind of keep growing. So let's say now there's an aspect of kind of everyone benefiting from this because of the tediousness of the work up front that can kind of go a long way down the road from that standpoint there. Um, and then I like to end all my presentations with this quote from Jim Rohn. We all are getting into this because of we are starting to value time more and more than what we previously thought before, and that's the main reason why I'm involved in real estate, so I can play with this guy more often. But like I said, I'm thanking you again for the opportunity to kind of add value. If you want to take a picture of this QR code, you get access to my email, my number, um, my electronic digital business card. You can just kind of see other stuff that I spoke on, and I realized the alignment on this is wrong. But yeah, but happy to answer any of the questions that anyone may have, and um, and go from there.
Yeah, awesome. Thanks, Larry. I've got questions, but I want to make sure people in at home audience have a chance. Anybody got something they want to ask? All right, man. I gave you a shot. Here we go. Well, I mean, my kind of big takeaway is there's a lot to this, and not only with taxes, they can change yearly. So to try and do this yourself is tough. I would say because tax laws change, like you mentioned earlier. You don't know what's coming down the pipe with future code type stuff. What should my relationship look like with my CPA as we're active real estate investors? We got deals going on. Should we be getting on the horn quarterly and talking specifics and going over quarterly P&L stuff in great detail to do some of this ongoing instead of having to recreate it all at once at the end of the year? I mean, what would you recommend? What do you prefer to see your own clients do?
I prefer all my clients to be damn near friends, to be honest with you, because like there's more to everybody, not just my clients, than just your business. Like you have a family, uh, you may or may not have kids, you're doing all these donations and whatnot, so you got other aspects of your life. So it's almost having to dig further to just knowing you, individual, and your personal as well as your business and investment goals, so that there's a full tax plan that could address all those things or kind of help you to that point. I said I was talking to a client today, and they really want to get to real estate professional status, and his wife like has a job, and like she's moving up pretty quickly, and he's considering kind of quitting his job. So it's like, okay, let's make a plan in place so that okay, you can kind of make steps into that direction. Um, what problems are you looking at from that standpoint, and then we can kind of start to kind of build a better tax strategy there to help reduce their tax bill, and or increase the amount of income that's not going to be taxed. Kind of the more the Warren Buffett approach from that standpoint there. So, like I say I'm typically meeting with most of my clients. Of course, there's during tax season because everybody wants to talk to me during tax season, but there's literally at least 2 to 3 more times a year where we're going to chat. Because depending on if your tax pro is you're also your accountant, because from a I guess because I'm a big dumb jock at the end of the day. From a football perspective, like the tax uh, goal itself is really more of just the game plan, but you really need your bookkeeper, your accountant to execute the plan so that you can actually take advantage of the tax plan itself. Because if the bookkeeping stuff isn't correct, or is it not aligning properly, and the documentation isn't there, then like we're not going to be able to take advantage of these things here. So that bookkeeper becomes more that first line of defense, and that whether or not that's your tax pro, it could be, it could not be, but you're basically going to be talking to your tax pro and or your bookkeeper. I would say probably at least 3 times a year, just to kind of catch up, see what's going on. You may mention something for the family perspective, like okay, whatever you got, little Jimmy now turned 14. Okay, let's put little Jimmy to work now from that standpoint and see if he can get involved with real estate. From that
12K a year, right?
What do you say?
12K a year. That's what you pay him, right?
Yeah, 12K a year. We can justify paying him 12K a year. We'll check. We'll make it happen from there. Then set him up with a Roth, and he gets that money goes in there tax free. And then after 5 years, he can pull the money out, his initial contributions, tax free from that standpoint there. So now you just kind of built his college fund a little bit from that standpoint. If he decides to go to college, instead of working with a 529 plan that traps your money in there, and he doesn't go to college, and you got to find a way to pull the money out of there.
Mhm. Yeah, no, that's okay. So, I mean, I think a lot of us are using third-party management, which kind of, for us doubles as our bookkeeper. They're doing the bulk of the bookkeeping work. And then we typically have a little bit of um, redundancy with our CPA because I think you guys got a slightly different lens than a property manager when it comes down to tax strategy. So probably, I don't know, 85-90% of the bookkeeping is done at the property management level, and the final tweaks are done at the CPA level. Is that generally
Yeah, I mean
a
that's
decent approach?
yeah, that's a great coach, but they're just going to get most of the grunt work in, and then the aspect of kind of keeping up with your tax pro is that okay, let's take a look. Okay, those some really big, huge expenses. Let's make sure those expenses are documented properly so we can keep those expenses. Because if they're not appropriately expensed a certain way, or they need to be capitalized, then we have to move them. But like that's just on the tax return piece, not so much on on the bookkeeping side. So like the bookkeeping kind of the starting point, and then like we're making adjustments on the tax return to to shape out what the tax picture is going to be from that standpoint there.
Okay, right on. What's up, crowd? You guys got anything else?
I was just gonna remind you of the time before you.
That's what I was.
Your
Yeah, I
next-
was.
Yeah.
Yeah. But no, that's good. If there's no more questions, we can wrap it up, Larry. It'd be it's getting to be close to reading time.
Like I said, I'm definitely, like I said, I'm about to put the boys to bed.
Yeah,
I
yeah,
definitely appreciate the opportunity. I enjoy this. It strengthens me, and like I said, for me to be able to add value to people, like I said, that's really why I'm in this to do. So like I said, if anyone has any other questions, my information is up there. Like, please don't hesitate. I get calls on this thing all the time. Just give me about now. Give me
yeah.
about
Cool.
48, 72 hours before I can reply back.
Yeah, no, certainly appreciate, because I agree. I like these longer form conversation things because you can get into the weeds a little bit and see some of the nuance and so on that goes along with a lot of this stuff. So, all right, well, should we wrap it up, everybody?
Thanks,
I
Larry.
think so.
Appreciate it.
Thank you for your time and everybody for coming. Thank you.
And yeah, we'll drop this on the YouTube channel. So if there's somebody that you think, hey, this is pretty good conversation, it's the Real Wealth Solutions YouTube channel. Probably be there in a couple of days or something. So
Sounds good. Sounds good.
hey, maybe see you on Thursday's call over in the Matrix, eh?
Yep. I think I cleared my schedule off of that, so I should be up there.
All right.
Everyone
Cool.
have a good night, and catch you around.
All right. Thanks again.
Night.